We're jumping straight into applied materials today. Everyone is watching the price action, but the real story is the massive structural shift in AI-driven capital expenditure.
It really is. I mean, that shift is already having a huge
We have a
impact.
huge impact. We just saw shares surge, what, 8.2% to a new 52-week high?
And that was right after the guidance from TSMC, which,
Wow.
is probably the most important signal for this entire sector.
It's the bellwether. When the world's biggest foundry says go, companies like Applied Materials just take off.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us. And you really hit on it. This wasn't some isolated move. We saw peers, Lam Research, for instance, also setting higher lows. It just confirms that big institutional money is flowing into the whole sector. It's a breakout.
For sure. And the quantitative data backs that up. The mood right now is strongly bullish.
All fueled by that AI optimism. Applied Materials is just sitting right in the eye of the storm.
Do yourself a favor right now, subscribe and hit the like button. Let's break down the bull and bear case for Applied Materials.
All right, let's get into it.
Okay, so let's unpack why all this money is piling in. The bull case really starts with, the fundamentals, just solid financial health and growth.
Right. Their fiscal 2025 revenue came in at $28.37 billion. That's a 4.39% increase over the prior year. Healthy.
But it's how they got that growth that's really interesting. It's not just one thing.
That's the key. So semiconductor systems, their main business, was up 4%. But the Applied Global Services division, that's their recurring revenue, hit a record $6.4 billion.
Which is so important for stability, right? That recurring revenue smooths out the cycles.
It absolutely does. And then you had the surprise from the display revenue.
Yeah, a 20% jump. I don't think anyone saw that coming. It's not the main AI driver, but it shows they're firing on all cylinders.
And what's really impressive, what seals it for me, is the efficiency. While all this growth was happening, their non-GAAP gross margin actually expanded.
By how much?
120 basis points. It landed at 48.8%. So they're growing and becoming more profitable at the same time, which is just textbook execution.
Okay, but let's get to the real heart of the bull case. The AI moat.
Yes.
It's not just about selling equipment, it's about what they sell. We're talking about high bandwidth memory, HBM, and advanced packaging.
Which are completely non-negotiable for building these new AI chips.
So for anyone listening, just to break down HBM, think of it like this. Instead of memory chips sitting next to a processor, HBM stacks them vertically, like skyscrapers of memory.
It's a great analogy. And
Yeah.
building those skyscrapers requires incredible precision. That's where Applied Materials comes in.
And we're seeing this move from just a concept to, massive revenue. They did $1.5 billion in HBM revenues in fiscal 2025.
And they're not being shy about the goal. They've publicly said they want to double that to $3 billion, and fast.
How are they going to do that?
It's driven by systems like their Kinex tool, which is for something called hybrid bonding. Now, hybrid bonding is a term you really need to remember.
It's basically gluing different chips together at an atomic level. Right?
Exactly. Sticking a CPU to those memory stacks. It's incredibly difficult
Mm.
and requires the kind of materials engineering that is their specialty.
Yeah.
Without it, you just don't get the performance you need for AI.
So this technical leadership creates these sticky customer relationships you always hear about.
It's the definition of a moat. Once a foundry like TSMC designs your tool into their process for something as complex as hybrid bonding, it is just way too expensive and difficult for them to switch to a competitor.
That leads right into their overall competitive edge. They have this dominant IP, this intellectual property, in what's called non-lithography.
Right. So if you think of lithography, ASML, as the process of printing the chip designs.
Like the printing press.
Exactly. Then
Yeah.
non-lithography is everything else. It's depositing the materials, etching the patterns, cleaning the wafer. It's the paper, the ink, the quality control, all of it.
And how dominant are they?
You have a 50% market share in that space over the last 4 quarters. 50%.
Wow. So they aren't even competing head-to-head with ASML. They own a completely different but equally essential part of the process.
It's a complementary position.
Yeah.
They're essential to the entire industry, which makes
Yeah.
them a safer bet in some ways.
And all that dominance, that high-margin business, it leads to just incredible financial results. In fiscal 2025, they generated $5.7 billion in free cash flow.
That's FCF. And for anyone new to this, that's the real cash left over after all the bills are paid. It's what management gets to play with.
And they used it. They returned $6.3 billion to shareholders last year.
Yep. Broke down into $4.9 billion in buybacks, which cut the share count by over 3%.
Making everyone's slice of the pie bigger.
And a 15% dividend raise, up to $2.46 a share quarterly.
Okay, let me jump in here and play devil's advocate for a second.
Go for it.
With this giant multi-year AI ramp ahead, shouldn't they be reinvesting every single dollar they can into R&D and CapEx? Is returning cash to shareholders actually a sign that maybe their immediate growth opportunities are capped?
That's a fair question, a really important one. But I think it actually shows the opposite.
Yeah.
It shows their core business is so profitable, their free cash flow is so strong that they can do both.
They can walk and chew gum.
They can fund all the R&D they need, like for their new EPIC Center, and still have billions left over to reward shareholders. It's a sign of incredible financial strength, not weakness.
That is a very strong counterpoint. Okay, that financial strength is a huge buffer, but no company is perfect. To be responsible, we have to pivot to the risks.
We have to. And the biggest one, the one everyone in the chip sector worries about, is geopolitical, specifically China.
Give us some numbers on that. How big is their China exposure?
For fiscal 2025, it was 28% of their total revenue. Now,
Yeah.
that did ease a little in Q4, down to 25%, but it's still a very significant chunk.
So what's the actual risk with that 28%?
The risk is that U.S. export controls directly limit their potential sales of high-end wafer fabrication equipment, or WFE. There's a ceiling on their most profitable growth segment in that country.
But there's a nuance there, isn't there, about the type of revenue?
There is. A lot of Applied Materials China business is for what we call mature node manufacturing, making older, less complex chips. Those face fewer restrictions than the equipment needed for the absolute cutting-edge stuff. For now, anyway.
So the risk is real, but it might not be as bad as that 28% headline number looks.
That's the argument. And honestly, the market seems to agree. Most analysts feel this risk is already somewhat priced in. The stock took a hit when the restrictions were first announced, so a lot of that bad news is probably in the rearview mirror.
Okay, risk number 2, the near-term softness. Despite all the AI hype, their actual recent results have, cooled off a bit.
They have. Q4 revenue was actually down 3.5% year over year to $6.8 billion. There's definitely a lull before the storm.
And their guidance for the next quarter for Q1 fiscal 2026 confirms that, right?
It does. They guided for $6.85 billion in revenue, but with a huge range plus or minus $500 million. That wide range screens uncertainty. It tells you we're in a soft patch before the real ramp begins.
So why is the stock hitting new highs if the current quarter is soft? That seems like a contradiction.
Because the market is looking right past it. It's looking through the next 2 quarters and focusing on the back half of the year. The strong margins, the HBM story, and that huge confirmation from TSMC, those catalysts are just overwhelming the short-term dip.
All right, so we have the bull case, the bear case. Let's make this actionable. What are the specific triggers you, the listener, should be watching? What's the next big date?
Circle your calendar for late February or early March 2026. That's when we get the Q2 fiscal 2026 earnings release.
And it's not just about the headline numbers. The entire bull thesis, the entire valuation, is hanging on a ramp up in the second half of 2026.
100%. You need to listen from management to explicitly confirm those H2 ramp whispers. We need to hear that foundries are putting their money where their mouth is on advanced packaging and HBM tooling. Any sign of a delay there would be bad news.
And outside of earnings, what about technology milestones? You mentioned the EPIC Center.
Yes. Look for news out of that facility. Any public demonstrations of their next-gen packaging tech would be a huge catalyst. If they can show visually that they are years ahead on something like hybrid bonding, it just validates the whole long-term story.
Okay, shifting to macro and policy. What's on the radar?
Keep an eye on any progress with the U.S.-Taiwan trade deal. If that moves forward, it could ease tariffs, stabilize the region, and just generally encourage more long-term tech investment there. Be a nice tailwind.
And what about the broader economy?
Just watch for easing jobless claims. A cooling but not collapsing labor market opens the door for potential rate cuts. And lower rates are usually gasoline on the fire for high-growth sectors like semiconductors.
So let's boil all of this down. What's the final synthesis here?
The core idea is this. Applied Materials has leadership in HBM and a 50% market share in non-lithography equipment. That position puts them right in line to capture 10 to 15% growth in the WFE market over the next 5 years, all of it supercharged by AI demand and foundry spending.
And the market is clearly buying into that thesis. The recent 8% jump, the new highs. It's all being fueled by that incredible $5.7 billion in free cash flow that's funding everything from buybacks to R&D.
I mean, the fact that the stock completely ignored the soft Q1 guidance tells you everything. The market has decided the near-term risks, like China, are already priced in. They've moved on.
So what's left to unlock is that massive multi-year upside from the AI build-out that really kicks into gear in 2026.
Exactly. And that leaves you, the listener, with a really interesting question to think about. Is this current momentum, this TSMC news, a signal for a quick trade? Or is this a multi-year core holding that you buy now to ride that massive AI ramp into 2026 and well beyond?
That's the lowdown for today. We'll be back soon with another massive market breakdown.